Operating profitability of the companies rose in the pandemic in the year 20 to 2021, reversing the prior 2-year trend of falling profits even as the impact on profitability and debt repayment capacity has been varied depending upon the size of the large firms. Large firms made good use of low interest rate, wage costs and raw material last year to boost operating profits, while large corporates strengthened their balance sheets. MSMEs experienced a dent in a financial performance. In the last 3 quarters of 2020 and 2021 combined, corporate sector's revenues and expenditure declined by 11.6% and 15.2% respectively, while operational profit, which is earning before interest and taxes or EBIT, increased by 7% on year to year as a recent assessment by the Reserve Bank of India. The impact of COVID-19 has been varied for firms of different size and nature of operations. Evidence from the advanced and emerging economies show that smaller sized firms are relatively more vulnerable to extended periods of lockdown. Larger firms may have found it easier to cut costs compared to smaller firms during the lockdown. In India, although the interest coverage ratio, which is ICR, deteriorated for firms on all of size categories in 2020 to 2021, small firms appear to have been affected more by the lockdown in Q1 2021. The RBI noted in its analysis on firm profitability and debt servicing capacity. Both small and large firms, however, improved their debt serviceability ratios in Q3 to levels which are higher than pre-pandemic period. The rise in profits and a sharp decline in borrowing costs led to recovery in their interest coverage ratio. Industry-wise sectors which depend on discretionary spending by consumers were impacted more, such as hotels, recreation services, gems and jewelry. Sectors which were excluded from the lockdown, such as food and utilities, experienced relatively lower deterioration in interest coverage ratio Q1 FY 2021. After the sharp fall in sales and profitability in Q1 FY21, following the nationwide lockdown last year, companies continued with their cost-cutting strategies in the following quarters. Falling interest rate, low wage and other input costs alongside recovery in sales enabled corporate India to straighten operating profits and balance sheets in the following quarters during the previous financial year. In Q1 FY21, average revenues from sales contracted by 32% for a sample of 2536 listed firms. Firms resorted to aggressive cost-cutting measures, enabling them to lower their total expenditure by 34%. Profits nosedived, endangering their debt servicing capacity. Indian corporates, however, adjusted quickly to the altered business environment. As sales recovered Q2 FY21, cost continued as a preferred path to regain efficacy and return to profitability, the Reserve Bank of India said. While revenue contraction moderated to 5.3%, total expenditure contracted by 12.5%, enabling net operating profit to rise by 33.4% in Q2. However, in Q3, revenue increased by 2.2% and expenditure increased by 0.3%, that led to further increase in profits by 35.6%. Rising profitability in third and fourth quarter helped in improving the firm's debt servicing capacity.